Hey, what's up, everybody? Welcome back to Investing Sucks. Today, we're going to be doing another video in the Your Company, My Analysis series that I recently started on this channel. So this is a series where you guys submit companies to me and I give my personal take on them. And we do an in-depth dive into everything related about the business and also do a valuation of them at the end to try and determine if the company actually represents good value. So today we're going to be looking at Boyd Group Services. So this is a rather unknown, I think, TSX listed company that has pretty quietly delivered pretty spectacular returns over the last 10 years. As we can see on screen here, close to 30% compounded annually, which is amazing. That's a very good return over 10 years. So this is the second installment of this series. So again, you guys can submit companies to me, submit companies in the comment section of this video. And I promise I'll take a look at every single company, but I might not do a video on all the companies because there's only so much time in a day. And I do get quite a lot of requests now that the channel has grown to a decent size. So what I'm going to do in this video is, like I said, go over who this company is, what they do, talk about some industry trends, whether they're favorable or unfavorable, and then do a discounted cash flow valuation. And the way I like to conclude these videos is I give my take on whether or not I would do more research into this company to try and understand them a bit better and maybe build a position in them, or if I would just move on based on what I learned about them so far. So that's really the whole point in these videos. I'm not going to outright tell you to buy or sell them because that's just not a really good thing to do on the internet. That's a decision that you guys have to make. It's more just me giving you guys a second opinion and taking through my thought process on how I would look at a particular company. So without further ado, let's actually dive into this video. So let's start by determining what this company actually does. So it's Boyd Group Services, and it's pretty simple what they do. They operate a non-franchise collision repair centers in North America. So it's essentially you get into a car accident and you need your car repaired. So if we look at their investor presentation, we can actually get a pretty good understanding of the company's actual strategy and kind of how their revenue is. So if we look at their revenue breakdown by country, it's mainly US. They are a TSX listed company, but majority of their revenue comes from the US. About 10 to 15% comes from Canada, and majority of their revenue is coming from insurance companies, not individual customers, which I think intuitively makes sense because if you get into a car accident, most people are going to have insurance and it would be covered by that. So because the insurance companies make up such a large portion of their revenue, relationships with them are very, very important. So they give some other additional details about the business. And then they also talk about their actual strategy. So they describe the market as fragmented. So fragmented really just means there's a large amount of small companies operating in the market. So total size of the market, they estimate just under 37 billion annually in US dollars. So that's the North American collision repair industry. And they're one of the what you would call the big three players in this industry. So it's themselves, Boyd Group Services, and then two other companies which are both owned by private equity companies. So they're actually the largest company that is publicly traded. And majority of the companies in this market are independent repair shops, 82.3%, whereas less are dealer-owned shops. So you can kind of decipher from that most of the companies in this are smaller. They're much smaller than Boyd, and they probably don't have as many locations as Boyd would do, which we'll get into why that's significant here. But they also talk about the consolidation in the industry. So this is a huge part of Boyd's strategy. They are buying up smaller companies in this market with the goal of consolidating them to achieve operational efficiencies, maybe achieve cross-selling opportunities, and to have a better service offering to the insurance companies. So the top three consolidators represent 18.2% share of this market in 2020. And in 2006, it was only 1.7%. So clearly not just Boyd, but also the other large operators see an opportunity in consolidating this industry, which could be for a number of reasons, but they kind of describe in this slide here why they think it is at least. So they have this thing called DRPs, direct repair programs, and they're really relationships between themselves and the insurance companies. So because the insurance companies make up 90% of their revenue, and there's really only so many insurance companies out there. So realistically, you're only probably talking about a few customers, and there's probably a few large customers, which would be the larger insurance companies that they're selling to. Those relationships become very, very important. So that's the whole point of these direct repair programs. And you can see they just list some points about it here. auto insurers utilize these DRPs for a growing percentage of their collision repair claims volume, so those insurance claims. And there's a growing preference among the insurers for these DRP arrangements with multi-location collision repair operators, which is what Boyd is. So that's probably why they're consolidating the industry. They see value in basically delivering what the insurance companies want, because that means the insurance companies are going to go with them more of the time. So they're trying to take advantage of that whole trend. So that's essentially what they're describing here. So huge part of their opportunity. And I'm sure when we look at the financial statements, we'll see that cash acquisitions are a big part of how they use their cash flow. Okay, next thing I want to do with this company is take a look at valuation metrics. So I pretty much do this with all companies that I look at initially, just to get a good idea of how the market is valuing this company now versus historically, because this can kind of help you understand the sentiment regarding this company. So I'm going to look at the price to sales ratio and extend it way back. And we can see a pretty clear trend of what's been going on. So the price to sales ratio has been rising for over a decade now. So based on that, we can determine that this company, in terms of its sales at least, has gotten a lot more love from the market. Because if we go back here, only at about a third, it was trading at price to sales. Their sales have been growing, as we'll see later, at a fairly high rate. And the ratio was extremely high here, which I believe was kind of just due to the fact that it was pricing in a recovery. So this drop here isn't necessarily because something bad happened with the company. It was really just a return to the normal phase, which this is much more aligned with the general trend we can see here. This was really just because they did, as we'll see later, suffer a pretty steep decline in sales due to that thing that happened throughout 2020 and 2021. So price to sales, good thing to look at in my opinion. Clearly, there's different things that can impact a price to sales ratio, such as if a company becomes more operationally efficient, so they have higher operating margins, naturally they're going to have a higher price to sales ratio because they're just more profitable. So those sales are now converting more into actual profit and cash flow versus they were before. So that's something that can increase it. Also, if just the market sentiment regarding a company gets more favorable, then you can see a rise in the price to sales ratio. So another valuation metric I like to look at is the enterprise value to unlevered free cash flow. So I'll pull that one up here. And unlevered free cash flow, this is when we do the actual DCF model, we'll get a better understanding of what this looks like. But let's kind of do the same thing, just drag it back for about 10 years to see what kind of trend. And this does jump around quite a lot, as we can see, because the cash flow metric can be influenced by many things, but there's also a pretty clear upward trend over the last 10 years. I can see back here, kind of after the financial crisis, it was only at about 5 times, but it's risen quite a lot. And now it's currently at about 20 times, but then recently spiked up to about 27 times. But clearly, the market over the last 10 years has come to appreciate this company more. That's really what we can decipher from this trend here. And this could be just due to the fact that they have delivered very strong shareholder returns. So people are taking note of that. And it's also quite possible, if we go to the financial review section of it, that people are just learning to appreciate this company more because their revenue growth has been quite strong for a very long time now. So I'm going to extend the financial statements, the income statement specifically, back many years. And we can see, except for this 1 year in 2020 when their revenue declined pretty significantly, they've been growing at high double digits pretty consistently. We can see in the earlier years here around 40, 21, 33%, 46% here, 40%, but now it's kind of tapered off in the more recent years. So their best revenue year was 2019, so before all the lockdowns occurred. So this probably reduced their revenue just because due to the lockdowns, there's less people driving around, which led to less collisions, which led to less revenue for them. That would be my assumption there. And then their gross margins have been pretty consistent over time. We can see about 45, 46%, not really any discernible trend there. And if we look at operating margins, again, we would expect this to increase because of their whole strategy that they said. They want to consolidate companies, make them more operationally efficient, and generate more shareholder value from that. So there is an upward trend. We can see in the most recent years, their operating margins got squeezed quite a bit. And when we look at the industry trends section, we'll understand why that is. But it was kind of in the 4.5%, 4% range here, and then it suddenly jumped up to about 6%. So clearly something happened here that led their operating margins to go up quite a lot. Now, we did say that they are making a lot of acquisitions. That's part of the whole consolidation strategy. So if we go to the cash flow statement, we should see evidence of that. And what I want to look at is look at how much cash from operations they're taking in and how much of that are they deploying in these cash acquisitions. And if we look throughout the years, we can see their cash acquisitions here. Most of the time, they're actually higher than their cash flow from operations. So they're not actually funding all of these acquisitions with the cash that the business itself is generating, which is interesting because then they're going to be needing to raise funding from other sources. So if we look at the financing section, we can see they're issuing debt, but they're also repaying debt. And they are also issuing shares. They actually had a pretty large share issuance in 2020 here, $164 million. So we're probably also going to see some dilution in the amount of shares outstanding they have, which again is not great as an investor because that means they're diluting your ownership percentage. You own less and less of the company. But if the way they're using that cash they generate is making the business overall more valuable, it's not necessarily a bad thing. Share dilution in and of itself isn't always going to be bad. It's bad if the money that they receive when they issue those shares is being utilized in such a way that it doesn't really make the business overall more valuable. So we'll scroll down, look at weighted average basic shares outstanding, and we can see pretty significant dilution, about 11.2 million shares outstanding here. And over the last 10 years, it's pretty much doubled. It's gone to about 22 million shares outstanding. So when we do the DCF valuation, we will take this into account. And I believe they also do have some share-based compensation, which is naturally going to cause dilution as well because they're issuing stock to their employees. So definitely going to be further share dilution if this trend continues. So again, we'll take that into consideration when we look at the DCF model. And now let's look at the balance sheet. So the balance sheet is something that I think you have to pay attention to with this company. So let's start by just looking at current assets versus current liabilities. So current assets in the most recent year, 234 million. Current liabilities, much, much higher, 367 million. Now, generally speaking, you want to see companies with more current assets than current liabilities because that signifies that they can essentially pay off their liabilities with the current assets they have, which is a stronger financial position overall. But of course, you have to take things into context. Now, if we look at their accounts payable balance specifically, so this is the amount of money that they owe to creditors, 256 million, and they actually don't even have enough cash on their balance sheet to pay that off. Nowhere near enough. They have 27 million in cash on the balance sheet, and they owe 258 million in funds to their suppliers. So that is a little worrying. That is a risk you have to consider with this company. And the company obviously is going to tell their story and say, we have access to the capital markets, we can issue stock, we can raise debt because we have these credit facilities that are untapped. And so it's not really an issue, which is true. But, this is going to lead to a lower credit rating for them. So if they do take on debt, their interest rate will be higher, which cuts into their profits. And there's a whole, cascading effect with this. And I think it's just the nature of the business they're in. There seem to be a business that's perpetually short on cash. They've never had a cash balance in excess of 100 million when they're doing close to 2 billion in revenue. So that's something to consider, right? And then we can see their long-term debt also pretty significant, 428 million versus the size of the business, which if we look at what the actual market cap is, about 3.5 billion. This is this market cap is in Canadian dollars. Financial statements are in US, so it would be, so you have to consider that as well. But overall conclusion from this would be they are fairly leveraged. So just keep that in mind. But if business continues as normal, then it's not really going to be an issue. It's really an issue if the business starts to slow down, they're having a hard time finding customers, their profit decreases and their interest costs remain the same. That could spell financial trouble for this company. Of course, they could tap into the financial markets to raise funding in the short term, but you want this business to thrive. And if they have to do that, they're probably not thriving. So definitely a risk to consider with this company. Okay, now let's get into the industry trends that are happening with this company. So normally I try and pull some sort of external research to understand the industry trends. But for this, I'm actually going to look at the company's outlook section because I think they detail the challenges the business is facing pretty well. And there are some pretty significant challenges, as we'll get into. So I'll kind of summarize what's on the words you see on the screen here. So currently, this company is facing two shortages, right? And we know as the economy stands today, there's various shortages going on, from labor to microchips to fertilizer, all sorts of things, right? You can even argue energy is in a bit of a shortage right now because of what's going on with the world. But the labor shortage particularly has been very negatively impacting this company. They mention here that they're offsetting the labor shortage with price increases to the insurers, but these price increases take time to come into effect, whereas the increase in the labor cost because of this labor shortage is an immediate effect. So we saw before their operating margins went from about 6% to 3%. I'd imagine this is a big reason why. I think labor is a big chunk of their income statement because they are providing a service at the end of the day. They need employees to provide the service to their customers. And the problem is this doesn't seem like it's something that is going to go away anytime soon. It seems to be a bit of a lingering impact. It's not something that's transitory, which you could argue the parts shortage is, which is the other shortage they're facing, where this is really impacting their ability to generate sales. They mention at the top of their outlook section here that they're having a hard time meeting demand for their services. And the reason that is because they can't source parts to actually fix up the cars that come into their collision centers. So that's a big problem because if that continues, that's going to limit their sales. They won't be able to grow their sales organically, and they're going to really have to rely on acquisitions, which can also lead to share dilution in order to grow the business. But as an owner of this business, you want to see organic growth. You don't want to see them just growing by issuing shares to acquire companies because that doesn't really generate great shareholder value unless they're able to achieve very strong operating efficiencies by doing that. But going back to the labor shortage, they mentioned that they're implementing a new program to essentially train people and help people to perform their job duties. So to me, that signals they're worried about this problem and if it's going to persist into the long term, because, and this is something else that could strain their ability to meet demand and prevent sales from growing. So to me, this seems like a pretty large risk, right? Because this is going to impact their ability to grow the business organically. If they can't get parts and they can't find people to perform these services, how are they going to grow, right? And when we do the valuation later, we'll see that the company has to grow. In order for their valuation to make sense, they have to grow. And it can't just be from inorganic growth through acquisitions. It has to be organic growth by just an increase in the demand for their services and them being able to facilitate more sales, because that will lead to more cash flow. But we'll get into that in depth when we do the actual valuation. Now, the other point I wanted to make is about the actual collision repair center aspect of this company. So as bad as it sounds, the demand for their services really relies on people continuing to get into car accidents. So in a way, you could look at investing in this company as kind of an alternate bet against technology, because cars are becoming more technologically advanced and very smart people are working on problems to limit the amount of accidents that happen. And you can imagine, say, if you go 50 years out in the future where there's a lot more self-driving cars, there's less people driving cars. My assumption personally would be that there's going to be less accidents as a result of that, because you have computers driving, which are less prone to error than humans. So in a way, you're essentially saying that I don't think that technology is going to catch on, because if it does, then a company like this would have to make a pretty significant pivot. They'd have to completely change their business, because less car accidents means they probably won't be able to remain a business for very long, because they rely on car accidents happening, as bad as it does sound. But they do make a point here, which I think they know that when investors look at their company, they're going to see that as a negative aspect of the company and why you shouldn't invest in them. But then they're trying to raise a counterpoint to that. And they're saying, as per industry studies, so it's not coming from them, it's coming from industry studies, the decline due to better collision avoidance systems that we're seeing in cars, the decline is going to be offset by increases in the cost of the repairs, right? So it's a change between lower volume but higher prices, which that is kind of a risky game to play, because if you lower your volume by a certain percentage, you need the actual price increase that results from that to be higher than the percentage that it was lowered by, if that makes sense. That's kind of just how the math works there. And then they're also saying that large operators such as themselves could mitigate the market decline by continuing to consolidate the industry, which is true. They could just use the cash they generate to buy new businesses and, like I've said many times, make them more operationally efficient. But in terms of a long-term strategy, that's not really solving the problem of, the demand for their services just being limited as the technology improves. All right, so let's actually dive into the DCF valuation now. So I have my assumptions up here for the valuation, and then the actual math aspect is down here. So we'll go through the assumptions first and then talk about the math aspect. And then I also have done a cost of capital calculation here, so I won't get too in depth on that. If you want to look at the nitty-gritty details, I'll link an attachment to this spreadsheet in the description of this video. So if you want to get more in depth and look at what I did, and decide if you agree or disagree with how I made these assumptions, and you can play around with the model a bit as well, feel free to do that as well. Just make sure you download it into Excel. Don't try and request access to the Google Sheet because I won't be giving access to it. Just download it into Excel. So revenue growth, I'm essentially assuming it's going to continue on a similar trend as what we've seen. So they're going to continue acquiring businesses with maybe some slight organic growth. Of course, we did just talk about why organic growth might be limited due to the shortages they're facing. But let's assume that those kind of get alleviated, right? Because we are looking out into the long term here. We're looking 7 years out in the future, not just what'll happen in the next 2 years. And the labor shortage, personally, I think that's going to have a lingering effect with the part shortage. Maybe that could get resolved within 1 or 2 years. It's extremely hard to determine that. But the whole point of this is not really for me to pull out my crystal ball and make a prediction on the future. It's to say, okay, given certain future assumptions, what would our returns be if we bought the stock at its current price? So EBIT margin, I have at 5%. Now, depending on when the part shortage gets resolved, it could be lower or it could be higher, right? Because if the part shortage gets resolved, say in the next 2 years, it could go back up to 6-7%. But if it doesn't, it could stay at 4%. So that's a pretty big aspect of investing in this company, if you ask me. But let's see kind of what's priced in, right? What are investors thinking? So I have the tax rate here. Perpetual growth rate is 1%. So pretty standard one at the end of this period. Cost of capital about 8.5%. It's a bit of a higher cost of capital because the company is more risky. We looked at their balance sheet. We saw that they have a lot of debt compared to their cash and their current assets. So they have a higher interest rate on the debt they do have, which is going to increase the cost of capital. Shares outstanding, this is what it's currently at, and I'm assuming it's going to grow at 5% a year, which is lower than what it's been historically, but they do have share-based compensation that will cause dilution, and they tend to be making acquisitions that exceed the cash they generate from their operations, which they're going to have to raise funding to make those acquisitions somehow, and it'll either come from debt, which they already have a decent amount of debt, so I don't think they would want to use that too much, so I'd imagine they would issue some shares as well. So we're basically saying with this that their revenue is going to hit about $6 billion by 2028. So pretty strong growth, right? There's a lot of growth priced into that. Their operating margins or EBIT margins will grow a bit. So I'm basically assuming with that the labor shortage, the part shortage gets alleviated. The taxes paid, capital expenditures, depreciation, I kind of just looked at historical trends, and then working capital investments. Not really significant amount there. It tends to level out to about 0 over time. So I just put zeros across the board. So then we get our free cash flow to firm. We prorate that for the percentage of the year it applies to, and we discount it to the present value. Again, won't get too into the nitty-gritty details. I'll attach a spreadsheet if you want to look at how everything is calculated. So we get about just under 5 billion enterprise value. We add cash, which in 2028, I basically said they'll have 50 million in cash and $1 billion in debt, because I would expect debt to increase, as we've seen it's been increasing for a while now. They're perpetually short on cash. I would assume that would remain the same. So then we get a value of equity of this, about 3.7, 3.8 billion. And then if shares are increasing at 5% a year by 2028, they have about 30 million shares outstanding, which gives a fair value per share of 125 USD. So their current price, it's 166 Canadian, but I converted it to USD because they report their financial information USD. So you have to, look at the share price in USD for it to be apples to apples. So based on those assumptions, they are very slightly overvalued at present time. And your annual return, if you bought the stock at its current price and these assumptions essentially came true, would be just under 8%, which is an okay return, right? I mean, it doesn't really compensate you for the risk of investing in an individual company, especially one that has a lot of industry tailwinds or headwinds rather, as they're facing with the shortages. It's a more leveraged company, so naturally it's more risky. So personally, if that's the way it is, I wouldn't be buying the stock because 8% isn't nearly enough return to compensate for that. And let's say the labor shortage kind of gets alleviated and their EBIT margin goes from 5% to 6%, right? So what's our return now? Now it's 9.2%. So it's still not really that great of a return, in my opinion. We are essentially concluding that the company is slightly undervalued, but really for it to be undervalued to the point where it's a screaming buy, you'd kind of want it to be your current price to be 50% of your calculated fair value, because that just takes into account, the fact that your assumptions are likely going to be wrong, right? And they obviously are going to be wrong. We can't predict everything perfectly, but we want to get a general sense and understand the business to a level where we can say, okay, I'm comfortable assuming that they will at least achieve these numbers, and the fair value per share, if they do that, is this. And that's currently at least twice of what their current price per share is. Therefore, the risk reward ratio is very favorable, and I think I'd do okay with this investment long term. But let's play with our numbers a bit more. Let's say they go 25% revenue growth for the next 2 years, and then 20% after that, with a bit more dilution. Because remember, if their revenue is growing at that, it's probably growing at that clip because they're making acquisitions. They have to fund those acquisitions, which, as we saw, they can't always fund the acquisitions with just basically issuing their cash flow from operations. They have to issue shares. So you can't have it both ways. You can't have high revenue growth with low dilution, because the dilution needs to happen for there to be high revenue growth. So in that scenario, it really doesn't change that much, still not even at 10%. So really what I would conclude from this is a company that I would probably avoid, just because it seems that the market is currently pricing in all these shortages to be alleviated, and it to essentially return to business as usual, and for the company to thrive into the long term, and for their strategy that they're executing to lead to everything that they're saying it's going to lead to: better operational efficiencies, more customers from the insurance companies, and so on, which to me seems like a bit of a risk, right? It's not guaranteed that will happen, although it could happen. So let's see what numbers we need for this company to really work out well. So let's go 30% and then 25%, and just increase the dilution very slightly, 6.5%. Now we're at about 12% annual return. So this is kind of more in the range of, okay, things are getting interesting, right? But these are pretty optimistic assumptions at this point, right? I mean, 6% operating margin when they're currently at 3% because of the shortages they're facing, and revenue growth that is much higher than what it had been historically. So personally, like I said, I think this company would be a pass for me. And I hope you guys did find this video useful. Let me know what your thoughts on this company are in the comment section of this video, but I'm going to wrap it up at this point because I think I've discussed everything I'd like to. So thank you so much for sticking around and listening to my analysis. And if you liked it, please leave a like and subscribe if you're new to my channel. So thank you guys, and I'll see you in the next video.